Hi, I'm Rick Kaler. Thanks for joining me. The stage in life when most adults have most need for life insurance is when their parents and their children are young. Unfortunately, this is often a time when financial resources are already stretched. Unlike health insurance and house payments, life insurance can easily be regarded as optional rather than a priority. To fully appreciate the value of life insurance, it might help to think of it in a little bit of a different way. Its major function for young parents is as income insurance. At this stage of life, it's not an investment. Like homeowners and auto insurance, it is an expense for essential coverage that you hope never to have to use. Its purpose is to provide for the family if one parent should die by replacing that person's paycheck. How much life insurance is necessary? Well, the short answer is as much as you can reasonably afford and more than you probably think you need. I recommend that parents of young children have a minimum of $500,000 to $1 million. Coverage for a stay-at-home parent is just as important as it is for a primary breadwinner. This might seem ridiculously high until you start looking at how much it costs to raise a child as a single parent. Just the basic costs of food, housing, health insurance, and daycare can be daunting. If you add in expenses like sports, music lessons, orthodontics, or college tuition, $500,000 doesn't seem like such a huge sum. What makes this level of coverage affordable for young parents is term life insurance. Term insurance, just like its name implies, is a policy taken out for a specific length of time, commonly 10, 20, or 30 years. It pays the beneficiary the face amount upon the death of the insured with no investment component or accumulated cash value. Because it is insurance only, it offers the most income replacement for the lowest cost. If you're in good health, term insurance is really relatively inexpensive. For a 33-year-old non-smoker, for example, a $500,000 policy would cost a woman around $30 a month for a 20-year term, or $45 a month for a 30-year term. A man would pay around $36 a month for 20 years, or $60 a month for 30 years. Of course, the longer the term of the policy, the higher the premium. If you're in your 30s, the ending date of a 20-year term insurance policy may seem really far into the future. Once a policy is in place, it's easy to disregard it except as one more regular expense. It can be a rude awakening then to reach your mid-50s and get a notice from the insurance company that your policy is expiring. The biggest risk with such a situation is that you aren't able to renew the policy because you've become uninsurable. To minimize this risk, it's wise to purchase the longest term policy that you can afford. It's also a good idea to review your life insurance needs every few years so that you can make timely decisions about whether you need to renew or extend your term insurance or even buy another policy. It's helpful to be clear about the purpose served by term insurance. In most cases, the focus is to provide for minor children, not to provide income for a spouse after the children are grown. Ideally, by this stage of life, a widowed spouse will not need a large life insurance policy to produce income. Instead, with the money the couple has saved through buying low-cost term insurance, they have been able to fully fund their retirement plans. Thanks for listening.